Because I know that this is something that people are talking about, or like just in the, in the general investing space, people are talking about this quite a bit. There seems to be a decent amount of fear around whether or not the S&P 500 is sort of like too concentrated. As in like too concentrated on a particular collection of companies or a particular sector. So I wanted to kind of take a look at that and see what I could find about the history of the index that should tell us maybe like how worried we should be. Because like this is something that people should have a little bit more awareness of, I suppose, because now like the majority of Americans are invested in something, whether that's through a 401k or through their own trading account or something like that. Then I think it's important to sort of like be aware of like how exposed the index itself is to certain sectors or to certain companies. So I wanted to do a bit of a dive, looked at a bit of the history, and hopefully you guys are going to find this interesting because I did myself. So we got to zoom out a little bit and first define what we're talking about. So what is the S&P 500? So the S&P 500 is a market index. It's a cap-weighted index consisting of the 500 largest cap companies in the U.S. equity market, or 500 large cap companies in the U.S. equity market. About 80% of the available market cap is covered by the S&P. So the S&P 500 is really meant to be like a representation of kind of like the U.S. economy as a whole, if that makes sense. We do see that like a decent amount of the market capitalization in U.S. equity markets is actually captured by the S&P. So in an index, just for a little bit of a definition, it's basically a basket of securities or derivatives or other instruments that represents the performance of a specific market or asset class or market sector or investment strategy or something like that. Make sense?
Makes sense.
Okay. So that's what the S&P 500 is. It's important to remember that it's cap weighted or capitalization weighted, because that's going to come up a little bit later. But a wee bit of history about the S&P 500, just for fun, just so that when you go to trivia, you're going to know all these answers. But the first iteration of the S&P can actually be traced back to 1923. That was before it was the S&P 500, but it was the first index that the Standard Statistics Company created that consisted of 233 U.S. stocks. Which was like, pretty interesting, a little bit different than now. And as it turns out, the formulation and the standards of the index changed many times over the next couple of years until March of 1957, when the S&P 500 that we know today officially launched. So that's kind of like the index does go back to 1923. We're going to look at some data that goes back to 1928. But it's important to remember that the index that we're sort of dealing with now and the standards with which new companies are added to it, evaluated, like those weren't really set until 1957, which is still like, it goes back quite far.
Yeah.
So a big part of this whole escapade came when I read the news that like SMCI, Supermicro Computers, is now joining the S&P 500, or it's set to join the S&P 500. And this is a highly volatile stock. It went from $400 to over $1,000 in like pretty much 3 months. A really crazy move. It's up over 1,000% just in the past year. So that led me to think like, okay, so should we be worried about market concentration? Should we be worried about too much tech exposure? Should we be worried about too much index exposure to these sort of like highly volatile companies? And this was kind of like the trigger that led to the manic spiral that resulted in this PowerPoint presentation. So, and it did move, SMCI moved even more after this news. And this was after hours. So like during very low volume trading, which is pretty impressive. But that kind of led me to think like, okay, so how are these index components actually chosen? And the S&P 500 uses a pretty quantitative method for determining what should or should not go into the index, but it's ultimately actually determined by a committee. So they basically look at eligible stocks and they decide like what should go into the S&P 500. And these, criteria kind of change year by year. But some of the ones that I found that were sort of more reflective of this year is that you have to have a pretty high market cap above 15 billion. You have to have at least 250,000 shares traded in the past 6 months. It has to be at least 1 year after IPO. And then the underlying must also be like highly liquid, and the majority of shares should be publicly available. SMCI is an interesting one because there's still like a very large percentage of the shares that are still privately held. So that's kind of why I wanted to like look into the criteria a little bit more. Those are the criteria. It's ultimately determined by committee.
Is that the same criteria from 1957, Julia?
I think it might have changed a little bit since then. I don't know exactly how it's changed throughout the years. This is the methodology that I found reflected of now. But I think that the broad principles still applied back in 1957, if I had to guess.
I should have expected a little bit of like a harsher criteria or more restricted. I think that's a simple one, except for the market cap above 16 billion, almost 16 billion. That's high, but the other one?
I will say that there's a lot of other criteria that I didn't include here. These are just the ones that I wanted to cover. So there's much more criteria. I included that in the references. So if you guys want to go actually look at that to see what the criteria are, they are a little bit looser than I kind of expected. But they like you can go reference that PDF that I linked in the references if you want to go take a look.
But to include supermicrocomputer to the S&P 500, you can see how loose are they.
Yeah, I was gonna it just seems so volatile to be in the market, like to be in the market index. But I mean, to be fair, like we don't really do a ton. Like I have not personally done a lot of research into like the most volatile components of the index. Like SMCI might be like, one of the most volatile, very large cap ones, but I haven't done a lot of in-depth analysis about some of the other components that might be even more volatile than that. Mm-hmm. But either way, it made me wanted to look into it a little bit more, and it kind of made me want to look at like sort of like how concentrated the index itself is, particularly in the information technology sector. So if you look at the makeup today, and this is from February of 2024, the information technology sector makes up about 30% of the index itself. But you do have like financials make up 13%, you have healthcare that makes up 12.5%, you have consumer discretionary at 10.6%. And these classifications, you can kind of look into the sort of the criteria that you sort of use to make these classifications. But when we're thinking about information technology, a lot of like the big tech companies that you would think of would sort of fall into that category, right?
Yeah.
So 30% of the S&P 500 is concentrated in a single sector. And when you look at the holdings, like the top 7 holdings is what I wanted to look at. So 1.4% of the whole index is 7 different companies. But when you look at these different companies, you have Microsoft, you have Apple, Nvidia, Amazon, you got Meta, and then you have both alphabet classes, right? Those account for 27%, of the weight of the index itself. So you have 1.4% of the the components accounting for 27% of the weight. It's kind of a lot.
Yeah.
It's kind of a lot. So this kind of begs the question, right? Because like this is a lot of like tech exposure. This is a lot of like, again, with this information technology exposure, really heavily concentrated in tech. So that begs the question, right? Is the S&P 500 itself too concentrated? Is it not a good representation of the U.S. economy as a whole? So like the S&P 500, which I'm using like SPY to sort of gauge, right? It returned about 25% in the last year, and only about a quarter of its components outperformed the market. So the majority underperformed compared to the market. So that basically means that the top quarter of the performers in the S&P are sort of like propping up most of the index, right?
Yeah.
With a particular concentration in the top holdings of the index, right?
Mm-hmm.
An interesting thing to look at is, so you have this thing called the RSP is the ETF that tracks the equal weight S&P 500. So instead of the cap weighted S&P 500, which is like, what we would measure with SPY, you can also look at RSP, which basically says if we give all of the S&P 500 components an equal weight of 0.2%, what would that look like? And so SPY returned, about 25% in the past year. The RSP, so the equal weight version of the index, only returned about 10%, right? So you can see how much those mega cap companies, like how much of an impact those are having on the index itself, which again, you have a 30%-ish concentration of only 7 companies, right?
Yeah, there's been a lot of talk about that, comparing the equal weight against the market cap weighted and also the share weighted.
That being said, we have to, I think, like do a little bit more of a subtle analysis to figure out if these higher levels of concentration are necessarily like a good or bad thing, right? It's certainly something like these higher levels of concentration are certainly something that people should pay attention to, especially because of how many people just have exposure to the S&P 500 now. With savings account or with like whatever, investment accounts or retirement accounts. So it's important to have this kind of understanding. But I think to understand whether or not, how worried we should be about this concentration, it's a little bit helpful to kind of look back at the history of the S&P and sort of how it's performed under different conditions. So to do this, there was a really interesting analysis that came out of FS Investments from May 2023. You guys should definitely go check it out if you want sort of more information about market concentration and how concerned everybody should be. But what they concluded, and I included the graph here, is that the S&P has not been this concentrated since about the 1970s. So what this chart is looking at is US market concentration of the last 40 years. So this is the top 10% of the S&P 500 of the market cap. So how the top 10 companies right now account for about 30% of the S&P's market cap. This is looking at that value historically going back to 1953. Make sense?
Yes.
So right now, the U.S. market concentration is near a 40-year high. And we can see around 1973 is the last time, 1970s is approximately the last time we had this level of concentration where we're using the top 10 components of the S&P 500 to determine concentration in this context. So in 2015, for a little bit of context, the top 10 holdings only made up about 18% of the index compared to now where we're closer to 30, right?
Yep.
So again, I wanted to look at is this a bad thing? Should we be concerned? And sort of what data points can we use to quantify that? So I pulled data for the S&P 500 going back to 1928. Again, what I want to know is more concentration. More concentration definitely translates to more risk, but that doesn't necessarily translate into more realized volatility. So when I think of how worried should we be, I want to know should we be worried about more realized volatility historically? That's one way that I'm trying to measure that. And when we look at the worst years of the S&P 500, again with that asterisk, knowing that the standards changed a lot between the 1930s and the 1950s. But when you look at the worst years, there's actually a really big distribution across time. So the worst year ever, it was 1931, it sold off 52%, 1937 sold off 37%, 2008 sold off 35% between 2008 and 2009, right? Sold off 35%, third worst sell-off in S&P 500 history, which is pretty significant. And then you have 1974, you have 1930, you have 2002, so from the dot-com bubble, and then you have the bear market from 2022, right?
Yeah.
And 1973, 1940, 1941. So you actually have a decent distribution of years across some of these worst performing periods in history. And you can see that a lot of these periods took place with, much larger macroeconomic events that had a big impact on the market, right? And so what I wanted to look at was okay, so when we look at the sort of best and worst performing years, you can see they actually happen at several different degrees of market concentration in the S&P 500. So for instance, when you have 1974 and 1975, the S&P 500 was about as concentrated as it is now. But then you have 2008 and 2002, when the market was much less concentrated than it is now. And then you have 2022, when it's about as concentrated as it is now. So you're getting the concentration of the market doesn't necessarily mean that you're more likely to actually have realized historic volatility. It does make that more of a possibility or something that you have to be a little bit more concerned about, but that doesn't necessarily mean it's reflected in the actual realized volatility of the market. Does that make sense?
Makes sense, yes.
And when we look at the best performance, we have we have the best performance, 1954, is again when it's a lot more concentrated than we are right now. We got 1995, 1997, 1989, which is again much lower concentration than it is now. And you have 2019 and 2020, which is about as concentrated as it is now. So you get a variation of concentrations and a variation of different market performances. You get very good performance, very bad performance, and concentration certainly plays a factor in that, but it doesn't necessarily guarantee that you're going to see a particular outcome, right?
Right.
So is the rolling 30-day historical volatility of the S&P 500. So we didn't have a VIX going back that far, but this is kind of a way to look at the VIX. What I wanted to look at is when you have a very low concentration relatively. So between 1983 and 2000, when the concentration in the S&P 500 was much lower than it is right now, what did the volatility look like? And what you can see is the average was about 13.7. And then we did have a very big spike sort of in around 1988, sort of the late 80s, right? So this is a very low concentration period. And then when we compare that to sort of the higher concentration period, so this is just one example, but this is from 1953 to 1973, you can see that along here. Your average was actually lower, and you did have a vol spike of 35, but it's not nearly as high as the spike of 80 that happened in around the late 80s. So we did see that volatility in this example, we're only looking at one time frame, but in this example, the volatility was actually lower on average, and we didn't have a vol spike. Make sense?
Makes sense.
So I guess to conclude this absolute rabbit hole that I went down, is the S&P 500 too concentrated? So not necessarily, I think is the takeaway from that. And you can check out that study from FS Investment if you want to sort of learn more about this analysis. But the market is more concentrated now than it has been in the last several decades. And a lot of that increase actually happened in like 2013 is sort of when it started. Just like the amount of growth from 2013 to now became a lot more concentrated in the S&P. But the increase in concentration doesn't necessarily result in more realized volatility. The bottom line is that sell-offs or periods of very high market volatility are usually triggered by larger macro events, not usually sector-wide events. So typically when you see like a big sell-off, it's because of a global pandemic, it's because of a global recession, it's because of some other factors. But when you have these events, these larger macro events, certain sectors they usually get hit much harder than others. And that can include the sector that the S&P is the most exposed to. So like you do have to be very mindful of that concentration risk, but that's not necessarily going to translate into realized like excess volatility or an increase in volatility. So hopefully y'all found that interesting.